Hi there. Many UK landlords think they are making profit, but after tax, the reality can be very different. Let's break down the numbers.
Welcome. Here at My Tax Accountant, we love to make complex tax topics simple for UK property investors. Today, we are tackling a really big one. We're looking at a specific tax rule that by 2026 could mean your rental property actually costs you more in tax than you make in profit. I know it sounds mad, but it's a real threat for landlords, so let's get right into it. So let's start with that question, because it probably sounds a bit crazy. Could your rental property really cost you more in tax than you actually get in profit? I mean, how can you possibly pay tax on money you haven't made? Well, believe it or not, a piece of tax law called Section 24 is making this a painful reality for a lot of people. To really get our heads around this, let's meet a fictional landlord we'll call David. Now, David's got a good full-time job, which puts him in the higher rate tax bracket. He's also invested in a couple of buy-to-let properties to build for the future. On the face of it, he's doing everything right, and he thinks his properties are turning a decent profit. But lurking inside his tax return is a nasty surprise, and his story is the perfect way to understand this hidden tax trap. So here's our game plan for this explainer. We'll start with David's tax shock and look at the actual numbers. Then we'll break down the rule that's causing all the trouble, Section 24. After that, we'll compare owning property in your own name versus in a limited company, examine if that corporate solution is right for you, help you think through the decision, and finally map out some clear next steps. Okay, let's get stuck into David's situation. This is where you'll really see how a portfolio that looks perfectly profitable on paper can give you a very nasty shock when HMRC calculates your bill. So here are the numbers. David's a 40% taxpayer because of his main job. His two properties bring in a rental income of £30,000 a year. Not bad. The mortgage interest on those properties costs him £15,000, and he has another £5,000 in other allowable expenses. You know, things like insurance and agent fees. So that's £30,000 income minus £20,000 in total costs, which leaves a cash profit of £10,000. Simple, right? Well, here's the problem. HMRC sees this very, very differently. And the reason for that big difference is a piece of legislation called Section 24. This is the tax trap we're talking about, the one that so many landlords are falling into. If you own rental property in your own name, you absolutely have to understand how this works.
So what on earth is Section 24? Well, in a nutshell, it's a rule that completely changed the game for individual landlords. The most important thing to know is that you can no longer deduct your mortgage interest costs from your rental income to work out your profits. Instead, you pay tax on your income without deducting the interest first, and then HMRC gives you a tax credit worth 20% of your interest cost. It might sound like a small tweak, but for higher rate taxpayers, the financial impact is absolutely massive.
Let's just compare the before and after. The old way was simple. Your mortgage interest was just a normal business expense. If you were a 40% taxpayer, you got 40% tax relief on that interest. Job done. But now, under Section 24, your tax is calculated on your rental income before you factor in that huge mortgage cost. You pay tax on that inflated number, and only then do you get a flat 20% credit. So if you're a 40% taxpayer, you are losing out on half of your relief, plain and simple.
Right, let's apply this to David and see the damage. We start with his £30,000 of rent. We take off his £5,000 of other expenses. But, and this is the killer, we cannot take off his £15,000 of mortgage interest. This creates a kind of artificial taxable profit of £25,000. Because David's a 40% taxpayer, the initial tax due is calculated on that, which comes to a whopping £10,000. He then gets his 20% tax credit on the interest, which is £3,000. But that still leaves him with a final tax bill of £7,000. Now, just think about that. His real cash profit was £10,000, and he's paying $7,000 of that in tax. That is a 70% effective tax rate.
And as if that wasn't bad enough, here's another kicker. Because Section 24 inflates your income on paper, it can actually push people who are near the basic rate threshold right into the higher rate tax band. So even if the real cash you're making hasn't changed at all, your official income in HMRC's eyes goes up. This doesn't just affect your tax rate, it can hit your personal savings allowance and even your child benefit. It really is a tax trap in every sense of the word. This whole mess leaves landlords like David facing a huge decision, a real fork in the road. Do you carry on owning property personally and just absorb this massive tax hit, or is there another way to structure things? So let's compare the two main options, because this is where it gets interesting. The biggest difference is right there on that top line, mortgage interest. Personally, you only get that 20% credit. But inside a limited company, Section 24 doesn't apply. The mortgage interest is a fully deductible business expense, just like it used to be. That's the key. The tax on profits is also lower. You're paying corporation tax instead of your personal income tax rate. But it's not a magic bullet. To get the money out of the company to spend, you'll pay dividend tax, and there's a bit more admin, like filing annual accounts. Let's boil it all down for David. We worked out his cash profit was £10,000. We then saw his eye-watering tax bill was £7,000. So at the end of the year, the actual net profit in his pocket from 2 properties is just £3,000. Now, what if David held those exact same properties inside a limited company? Well, his net profit after paying corporation tax would be £8,100. That is a huge difference. Looking at those two numbers side by side, you'd think switching to a company is a no-brainer. But, and you knew there was a but coming, it's not quite that simple. So, let's properly examine this corporate solution. Is setting up a limited company the silver bullet for every landlord getting hammered by Section 24? Or are there some hidden costs and complications we need to talk about? The biggest attraction, of course, is the headline tax rate on profits. As you can see, David's paying 40% income tax on his rental profits. A limited company pays corporation tax, which is much lower, currently between 19 and 25%. That immediate gap is where most of the potential tax saving comes from. However, and please, this is a really big however, there are some major catches. You can't just move your properties into a company for free. In HMRC's eyes, you are selling the properties to your company at their current market value. This can trigger 2 enormous tax bills right away. First, capital gains tax for you on the profit the properties have made, and second, the company has to pay stamp duty on the purchase. Those 2 upfront costs alone can run into tens of thousands. On top of that, you often face higher mortgage rates, you've got accounting fees, and like we said, you're taxed again if you take profits out as dividends. And this brings us to a really crucial tip from us here at MTA. Incorporation can be an incredibly powerful strategy, especially if your plan is to reinvest profits and grow your portfolio. But you absolutely must do the maths on the upfront transfer costs. For some landlords, the immediate hit from capital gains and stamp duty can wipe out any potential tax savings for years and years. You have to model the costs before you even think about acting. So, with all of that to think about, how do you even begin to make a decision? Well, let's break down the key factors you need to weigh up for your own portfolio. First, what's your personal tax band? If you're a basic rate taxpayer, the benefits of doing all this are much, much smaller. Second, what are your goals? If you want to reinvest profits to buy more properties, a company is great. But if you need that rent to live on day to day, it's less attractive. Third, portfolio size. Honestly, with the high transfer costs, it often only makes sense if you have several properties. And finally, you have to think about the future. New digital tax rules are on the way, and there are already property tax hikes scheduled for 2027. Phew, we've covered a lot of ground, from that initial tax shock right through to the nitty-gritty of the corporate solution. So let's bring it all together and talk about your practical next steps. So just to quickly recap the main points. 1. Section 24 is a game changer that can seriously inflate your tax bill if you're a higher rate taxpayer. 2. Limited companies are a potential solution, but they are not a simple fix and have big upfront costs. 3. There is no one-size-fits-all answer here. The right structure is all about your personal numbers and your goals. And 4. The rules are always changing, so you have to stay ahead of the game. And that really brings us to the final, most important question. When you look at your own properties, your own income, and your own future plans, which path is the right one for you? Look, this is not a decision you should be making lightly, and it's definitely not something for a quick back-of-an-envelope calculation. Getting this right can save you a huge amount of money and stress. It is a major financial decision, and it's one where getting professional, personalized advice is absolutely crucial to protect your investment's future. And just before we finish, the usual disclaimer, please remember this explainer is for general guidance. Tax laws are complex and they change. It is not a substitute for professional advice tailored to your specific circumstances. If you'd like to model exactly how this would work for your portfolio, please get in touch with us at My Tax Accountant. You can call us on 0208 570 8531 or drop us an email at info@mytaxaccountant.co.uk. And if you found this useful, please do subscribe to our YouTube channel for more updates. Thanks so much for watching.